Mike, hang with us because we have the question of the day, which is tech trash in 2022? And we asked that question because NASDAQ is now off another 0.7%. It has been a terrible 4 days for tech stocks, particularly the NASDAQ 100. Romaine Bostic, co-host of Bloomberg Markets The Close, is also joining us. Hey, Romaine, I know you guys were all over this yesterday, too. Yeah. What are we looking at here? Like, are we looking at, like, NASDAQ just off its highs here and this is normal? Or are we looking at something more shifty here?
It's a little bit more structural, a little bit more fundamental, and I think the key word is fundamental. Remember, we've been basically ignoring fundamentals, at least most market participants have now for the last couple of years because of that sort of full-on embrace by the Fed, whether it's real or by perception here. But now, of course, as that accommodation is perceived to be lifted, coming down in 2022, you have to look at some of those multiples, some of those valuations. A lot of these tech stocks, they have no earnings. So if you're trying to look for a PE, there is no E to measure that PE. And those that do have an E, well, think about this. You're paying 30, 40, 50 times earnings for some of these names in the NASDAQ 100. In fact, some of the big names in there have triple-digit price-to-earnings ratios. And if you look at it on a price-to-sales basis, it's not much better. You're basically paying almost 10 years out for some of these names on a price-to-sales basis. And that's really what's concerning people. With a higher rate environment and a less accommodative Fed, can those multiples stand up?
It's all about how high rates go. Ultimately, I think that's the question the market's trying to figure out here, Romaine.
Yeah.
Mike, let me come to you on that issue. If we do QT, if the Fed decides to reduce its balance sheet, does that mean that the terminal rate doesn't go as high? And if so, is that maybe a silver lining here for the tech sector?
Well, it could be. The problem is nobody knows at this point exactly what impact the Fed's rate moves are going to have or balance sheet moves are going to have. They can anticipate that it will slow the economy and bring interest rates down some, but how much, we don't know. Part of it because of all the fiscal stimulus that went into the economy over the last 18 months. We're waiting to see what happens with consumers. Do they really, really pull back? The minutes yesterday didn't add anything new to that debate, but for some reason, the markets decided it did. They gave us the prediction for 3 interest rate moves back in the dot plot at that meeting on December 15th. And they also suggested that interest rates are going to be or inflation rather, is going to be higher than they had thought back in September.
Can I just interject, though? Because I think one part of the reaction that we saw yesterday had to do with the perception, Mike, that the Fed was moving faster than I think what a lot of people thought they were. I think there seemed to be some people in this market that thought this was going to be much more of a gradual process. You have, of course, the taper, then you have some sort of rate hike cycle, and then maybe potentially a runoff on the balance sheet. And there seems to be, whether fair or not, a sort of a reassessment here that maybe all this is going to be packed in much more towards the first half of the year rather than drawn out over maybe a 2-year period.
And which raises the question, guys, is that how can someone come in then and buy the dip? I mean, Goldman Sachs talking about how hedge funds were selling technology pretty hard. I just want to point out some market action for today, guys. You got Rivian down 12%. Rivian was already getting hammered with EV stocks. GameStop down another 6%. AMC also down by 6%. And I'm just curious as to, like, the positioning, right, in the market from the hedge funds, from the retail investors, Romaine.
Yeah, the positioning, and look, I mean, partly to Mike's point and partly to your point, though, is that there are still economic fundamentals here that do suggest a stable economy and one that's going to be stable enough to support some of those companies. All the names you just mentioned, I guess they would fall, for lack of a better word, into some sort of degree of instability with regards to their fundamentals. Why are bank stocks still getting bid, though? Why are material stocks still getting bid? There's still a bet here that you are going to have a strong economy. The Fed is going to spook a lot of people, but I think people feel that when you get to the other side of this tightening cycle, or at least you start to get the start of it here, maybe people will reassess and find something to actually buy the dip from.
Romaine, what do people do, though, if they're selling tech? That, I think, is one of the key questions. Do we just do what we've been doing, which is rotating to other parts of the market? And does that rotation have the same effect at an index level? The market had got very narrow into tech. Big name tech has really been the place to be, and the only place to be in so many ways. But below that, we've had this ongoing churn within the markets. Yeah. Is that what persists here? If tech is trash for 2022, is that meaning that money goes elsewhere? Or does it go to cash? Does it go to bonds?
Yeah, I don't have
an alternative.
It's a great question. I don't have a definitive answer, but I'll tell you this. I mean, you know what we saw last year. It was basically a rotation. Money wasn't necessarily flowing out of the market. It was just rotating around. I think what we've seen in the first few days of this year and even the last week of last year is money coming out. You see that reflected not only in some of the ETFs that track equities, but some of the ETFs that, of course, that track bonds as well. The question is, how long does that money sit on the proverbial sidelines before it comes back into the market? That question, I don't know. I think you may have to wait until January 26th before people maybe feel a little bit more comfortable coming back in.
Well, Mike, which I think then brings us, full circle back to the Fed here. And just for some insight, we're looking at NASDAQ 100 off another 0.8%. The NASDAQ slipping really hard after that services number missed, but inflation still higher. That equity index now down by 1%. How much of a tech tumult is the Fed going to be able to handle?
Oh, quite a bit. As Romaine said, we've got some elevated asset prices, shall we say. And the Fed knows that, and they know that those stocks are probably going to go down. But as he pointed out, bank stocks, they benefit from higher interest rates, and so bank stocks are going up. It's not going to be the overall market. We may get a correction, but the overall market isn't going to die because the Fed moves 25, 50, 75 basis points this year. It's the financial stability aspect of it, they're watching, but they're not too concerned about it.
Okay, but just worth pointing out, actually, as I see it come onto my screen, Rivian now down 16. It's below 78, which is the IPO price. So we're getting some fairly punchy price action, particularly at the less profitable end of the tech spectrum, let's put it that way. Mike, what about financial conditions? If the market falls out of bed, say we get a 10% correction, say we get a 15% correction, that's going to have an impact on the FCON function on my Bloomberg screen. How does the Fed react to that? Is it less focused on financial conditions in the way that it was, say, 12 months ago?
Yes, it's less focused because financial conditions have improved a lot, and we are still extraordinarily loose in terms of conditions. There's a lot of cash out there. The Fed's going to obviously follow that, and Jay Powell talked about this at the December 15th meeting press conference when he said if the economy comes out slower or starts to slow down, then we'll adjust our pace of monetary policy as well. The Fed is not promising you they're going to do 3 rate hikes starting in March, although the market may want to think that today. They're saying that we think the way the economy will evolve, you'll probably have 3 rate moves over the course of the year. But if the economy is faster, we could raise more. If the economy is slower, we could raise less.